Uncle, it started.
Hey, hello everyone. My name is Rahul Bothra, and I'm the CFO at Swiggy. We are India's largest food delivery and hyperlocal services company. Today we have a very interesting topic on air. It's called the startups and venture capital. Obviously, we are seeing a lot of excitement around the venture world, the startup ecosystem, and it ties in very well with the theme of your conference, and the workshop is around Profitech. So diving in into the contents, what over the next 45 to 60 minutes we will deep dive into is the startup and the venture world. What's the big deal all about? We will look at the overall ecosystem, the universe, and how things have been evolving in this space. Understanding little bit more about the venture capital world, who are the key constituents and the success metrics as defined by these ecosystem players. We will look at key components of fundraising. It's again a very important aspect of running and growing a startup, including decisions around when's the right time to take debt versus equity. We will then deep dive into a few of the startup valuation methodologies. It's an art as well as a science. We'll try to cover both of them. This one specifically will cover more on the early stage startups and venture systems versus just only late stage. So there would be a few things that I will discuss around how the VC world looks at startups and how do they value specifically the early stage ones. Then we will do a little bit of deep dive on what's a good pitch deck look like. Many of you who may be wanting to either start up now or immediately sometime later, it would be a good useful inputs for you folks to think about when you go and pitch to some of these investors. So here's a quick snapshot of what the venture world investing horizon looking like. Just in the first half of this calendar year, we have seen close to 100% increase in the overall investments that have happened in the startup ecosystem and also the venture capital ecosystem. Close to $300 billion have been pumped in globally, which is approximately 95% higher than the same time last year. We are also seeing a boom of number of unicorns. Now, unicorns are startups or companies that are valued over $1 billion, with more than 250 new unicorns being born just over since October 2020, and we are seeing every month more additions to this number. We are also seeing a lot more late stage funding and surge in investments in specifically in mature companies. And we have seen 1,600 such late stage investments having happened in just this year. Globally, what we are seeing over the last couple of decades is that the startups ecosystems are reimagining the future. If you look at the market capitalization of the top 10 companies globally, 7 of them have actually been backed by venture capitalists. These are, overall 42% of public companies were venture backed. And 63% of world's total market capitalization is also represented by companies that have been backed by venture and private equity investors. We have seen close to a third of the world's total employment being now generated by these companies. And these are also very lucrative to the investor base who come and invest in these ventures with an overall IRR, which is the internal rate of return of over 20%, with an average holding period of 4.5 years for these set of investors. So this is why this is so important today to understand how does this ecosystem playing out. A lot of traditional companies that used to be funded in the earlier era today are going through a certain revolution. There's more technology investments happening in the technology space in companies that are using technology to grow the overall market. Now, if you kind of look at where the startup ecosystem begins and what are the various stages of this journey, what I'm calling the cradle to glory past the death valley. Early stage startups, they are typically one or multiple co-founders who start off with seed capital. These typically go with funding from either their friends and family or early stage angel investors. There are a lot of accelerator funds who invest specifically in seed stage ideas. When we say seed stage, these are founders or entrepreneurs who are looking to solve a consumer problem, who are looking or a B2B problem, and who are looking to build the product or the service to be able to commercialize it at a later point in time. Unfortunately, nine out of 10 companies do not survive this valley of death because this is a high risk, game. Many times, the early stage ideas, itself are not sufficient because they also have to be executed, and probably 90% of value lies in execution and not just the idea. So again, great ideas may not work very well because of various factors, including the timing. They may be too early or too late into the world. As a company matures, they can access to various rounds of financing, where you start getting in a lot more interest from venture capitalists. You get a lot more alliances. You could go on to raise various rounds around series A, B, C. There are various alphabets that you could do multiple rounds before you decide to take your company public. And obviously, as once the company is taken public, the maturity profile reaches a certain level. Now, if you look at this chart is capturing a lot of what's really happening around the growth aspect of a business. There are a lot of words here which typically mean that many of these early stage startups have to go through the cycle, as I mentioned in the previous slide. Uh, what are the various pathways and risks that companies go through as they go in their evolution? Initially, at the concept stage itself, the key risks could be around the technology that the company is going to use, the product that they would be launching in the market. The key, finding talent is very, very important. Again, early stage founders would need to not only attract a lot of good quality talent, but also be able to retain them because there's just so much competition in the market. So that's again a significant risk, that if you do not have the right team with you very early on, who is able to scale with you, then it could materialize into the startup not doing really well. Financing again is a very key component. You need to raise enough and more capital to be able to sustain the growth momentum, to sustain the operations till the company becomes profitable. When you start from the overall idea generation to rolling out the product, you would have to figure out what is the market fit, what is the problem being solved, is it really significantly superior than an existing product in the market. Otherwise, a Me Too player would lose steam very quickly. Once the company starts scaling, then you start thinking about the business model. That means that you have already been able to solve a consumer problem. Now you need to also think of the business model, that how would you monetize your company? How would you go about executing growth while turning into a profitable company? Again, from there on, the expansion mode, where you would expand geographically, increase the overall market. Could be competition. How are you able to build moats in your business so that any new or existing competition is not able to dethrone you from the place that you have already reached? And all of this may require you to raise sufficient capital till you get to a stage where you become operationally profitable. This slide really is about what the structure of a private equity or venture capital firm, the key constituents of it. So very broadly, there are two key constituents in this. One are the providers of capital. They are called limited partners or LPs in general parlance. And these are people who are providing the capital to these VC funds and the private equity funds. and they are then operated and managed by the general partners or GPs, who are really professionals, investment professionals who have been in this industry, who have invested or operated, who have not only invested capital but also operated companies in many cases. So they would together they would come together to launch this VC fund or private equity fund and go across investing into their portfolio companies. Again, there could be various themes of these investments. Different funds would have different themes depending on what they are good at, whether they could focus on early stage, mid stage or late stage. They could also focus on specific geographies. So you could have specifically a Latin America fund or a European fund or a Southeast Asia fund, where they would go and seek active investment opportunities in companies around these specific geographies. They could also be sector specific funds, where they are specialists. They are specialists in areas that they know really well about, whether it could be consumer tech, it could be the education tech, pharma, or increasingly as green tech becomes important around the whole sustainability and governance aspect of running companies. I think one of the key questions that early stage founders of companies have to really ask themselves is when is the right time to raise, and how much should be raised during this journey. So one thing that we all should recognize is that investor money does not come cheap. It's not only while it gives you access to capital, it also gives you you are giving up the future upside of your business potential. So you have to be very careful when you decide to pare down your equity and start getting investors. Another important aspect is that not all businesses are fundable. They could be because external funding comes with a certain exponential return expectation. If your business is going to operate in a niche category which is not going to scale, then you're probably better off by accessing either debt capital or bootstrapping your company, because then the venture capitalists who would you would not be able to attract such VC monies, which comes with significantly higher return expectations in your business. So it has to be scalable. The idea that you are working on, if it's scale, then it is not ideal for raising venture money. The timing of it, again, raise whenever it's available, and the fun part of it is generally available when you don't need it, right? So I think sometimes there are a lot of external factors that influence the overall economic climate of funding. There could be excess liquidity in the market, and today it is those times where there's a lot of excess liquidity chasing high quality ideas and good high quality execution companies. So there's a lot of capital available, but then before the funding window dries up, it's always good to stock up the capital specifically for your needs, so that you have sufficient runway to meet your business goals, either to go up to the next stage of financing or till you become profitable. So typically, in terms of overall runway, and our runway is nothing but the money that you need to sustain your operations, before the funds say dry up. So typically, say if you're losing $500,000 every month in salaries and other overheads, and you would need, say for example, 12 to 18 months at least minimum capital, which means that you need to have $5 to $10 million of capital to be able to sustain yourself. Again, the market opportunity is, you have to define the market opportunity and the problem you're solving. There has to be a very strong product market fit. While you may have a great idea, you may also execute it well, but it may not have any takers in the market. So that business is not funding ready. You would have to, as I had mentioned, find that solution which sticks off with the consumers. There's a not only are able to attract but also retain these consumers, because you need to create this flywheel of growth, both from new customer acquisition and also retaining existing customers. Spreading out the capital raises again is very important for early stage companies because if you raise too much capital, you are giving up significant upside very early in the opportunity, in the overall opportunity creation. So if you spread out your raises, your company typically will grow. If you're doing well, it will grow in valuation over time. And if you are able to take, smaller, rounds of financing, then you get the benefit of increase in valuation at the same time, reduced dilution in. One thing which I had mentioned about, where early stage founders or companies will have to decide is about whether they should raise equity financing or debt financing. And now there are pros and cons of both. Specifically, if your business is not going to generate operating free cash flows early on, you are better off just taking equity because in debt financing typically you would have to pay not only coupon interest periodically but also amortization of that debt over a period of time. So what typically would happen is that you would have to make a choice whether for your stage of business and the kind of risk that you want to put that business into, whether you would go for equity or debt. There are various instruments currently available in the market. Again, on equity, common equity is what the founders start off with. Typically, investor capital comes in the form of what we call the CCPS or the compulsory convertible preference shares. These class of shares have some bit of higher rights compared to the equity class holders around liquidity preference. Now, liquidity preference is nothing but if money is to be returned to these founders for any reason, or to the investors or the founders for any reason, then who would get access to the capital first. So the LP rights define who stands in the queue to be able to take out capital before the others. There's also, early stage companies get into a simple agreement for future equity called a safe instrument. They are in the nature of convertible instrument notes, where typically what you would do is issue these notes without defining the valuation from early stage investors, because the company is new and it sometimes becomes difficult to ascribe a value to early stage companies. So investors would go about and invest money nevertheless with a conversion instrument in place wherein it would be decided between the founders and the investors that at a later point in time, whenever the company goes for an external round of funding, their capital that was invested in the first place through the safe notes will get converted to equity at a certain discount to the subsequent round. So it is very founder friendly because you don't have to go through lengthy paperwork and defining various rights and obligations, and also valuation which becomes sometimes tricky during the earlier stages. When you look at the overall debt side, there is also a concept of venture debt. Now, venture debt are debt providers who provide you access to capital without collaterals, which necessarily means that they are taking higher risk, and they would therefore expect not only higher coupons are the interest payments for their capital that they have provided, but would also expect certain upside in the form of equity warrants, which they could then trade and sell off in the market to make gains. Again, they come with certain higher rates, but the good part is that there is no security or collateral that needs to be offered to these venture debt providers. You could also, issue or raise convertible debt. Convertible debt is in the nature of, debt which gets converted into equity at a later point in time. So till it gets converted into equity, you would have to pay the interest up to that time. And post that, it could be converted into equity. Again, normally it is done at a discount to the later stage valuation marks. Then the other usual, debt which is available is term loans, which are provided by both banking and non-banking financial companies. But there would be requirement of providing collaterals, and a working capital loan is to sustain your operations, specifically if there is a certain delay in receiving your receivables versus paying out to your creditors. So founders would typically have to discuss and decide that what is the right instrument to be able to finance their company at a specific stage of their growth. So at different points in time, the overall requirement could be very different depending on the need and the stage of that business. So let us switch gears now to really, deep dive a little bit about around valuations. It's a very interesting topic. Obviously, I will not be able to do justice, fully because it's an ocean in itself. But what I will try to do over the next few minutes is to provide you some, method to, the madness that gets applied specifically in the early stage companies. So before we dive into specific, valuation parameters itself, one thing which we all should note is that the venture capital investors, their expected return norms are not through a normal distribution. So a normal distribution curve will give you, overall an average performance, typically within, 68% will fall under one standard deviation and 99% within three standard deviation. That's how normal, distribution, or your returns get distributed normally across your portfolio companies. But unlike a normal bell curve distribution, the VC investor ecosystem operates on what is called the long tail or the power law distribution, returns, where what would typically happen is that very small proportion of your investments will give you significantly high returns. So in the example that I've given in the slide is that now, if you're investing in 10 companies, one or two of those companies could give you anywhere between 10 to 100x return. And that is, the hyper performers where therefore VCs would come in early with, significant stake and then stay with the company till they mature and go public. We have enough and more examples where we hear about, a $5 million check becoming equivalent to $1 billion in that 5 to 7 year period. There are enough and more examples where VCs who are able to identify such companies, such founders, and are able to partner with them over the course of their overall growth, they tend to make significantly high returns. Then in two or three companies out of those 10 may give them average returns of around say 2 to 4x. But more than half of the companies would actually get impaired, or they may have to sell at a lower than the investment cost. So with this in the background, one thing we have to understand is that whenever venture capitalists are investing money, it is not to get average returns, but they are investing with a outside chance of making really large returns from a small set of companies by this power law distribution curve. Now, just specifically going down into the evaluation methodologies that are used, in early stage startups. The first one is called the multiple X ask method. Very simply put, any business that needs a certain amount of capital, the investors would ask a certain ownership, right? So typically, if there are investors who look to own a third of the company or 20% of the company. We have seen this example in Shark Tank, where the founders or the entrepreneurs would be pitching to the sharks, and they would say, okay, give me X, for X dollars, I will take 5% of your company. So then that becomes the valuation of that company, right? So for example, if $1 million is being asked in that financing round, and the investor wants 20% of the company, then the valuation becomes $5 million. Similarly, if the ownership is being asked of 33.33%, then the valuation becomes $3 million. Now, these are done again for seed stage ideas where there hasn't been a product that has been formed, or the it's not been executed, and the founders are seeking this capital to be able to really establish their product in the market, be able to fine tune that solution that they have been thinking of, to be able to provide work with it, provide with the technology. The next one is the VC method, which is based on the expected return profile of the investor. So as we discussed, that VCs typically have large IRR or return expectations, and they would then say that, okay, if I need to give you $1 million, I would be expecting that this $1 million should give me at least a $10 million return in the next 5 years. So then they work backwards to say that if how much of the company's ownership they need, that they will be able to generate the expected return. So just to give you an example, over a 5-year period, if you need an IRR of 50%, then $100 million company would be valued at $13 million today. So that's therefore the investors would look ahead and say, okay, in 5 years this company could get to $100 million, and therefore if I were to invest 13 million, the amount of stake that I need, I will calculate so that I exit with a 50% IRR over 5 years. As the companies start maturing, and there are, say, more examples of similar companies in different parts of the world or in the same part of the world, then investors start doing comparable company analysis. They would look at companies who are in a similar business profile, similar stage of maturity, at what is the peers of such companies getting valued in different parts of that country or another country. Either it could be in the form of revenue run rates, that okay, this is $1 million run rate company is being valued at $10 million, therefore a $2 million company gets valued at, say, $20 million. $2 million run rate company. So this is how it's called comparable company analysis, where you look at companies that are in similar stage of evolution and maturity, and therefore you can equate them, and therefore do this peer analysis and compare their metrics to be able to establish the valuation for the company in question. As things start moving around, as I mentioned, there would be in a growth stage, the product market fit gets established, the company starts increasing revenues, the cost of customer acquisition starts going down. Then you will typically find then mature companies starting to talk about profit multiples, or revenue multiples. The last one on the slide here is called the discounted cash flow. Now, this is the pristine cash flow method used to evaluate again mature companies which have clear line of sight of profitability, and a horizon you can estimate with reasonable certainty over the, say, next 5 to 10 years, which is called the horizon value. So what you would do is you would look at the company metrics today, and then take assumptions of growth of both revenue and profitability, depending on the drivers of both in that particular market, and really forecast the profitability or the operating cash flows over the next 5 to 10 years, which is called the horizon value. And then add to it the terminal value, which means that if the company is going to operate in perpetuity, what would be the value of that company in the end of 10 years. So you basically use use the discounting method here, where you look at the overall growth rate and the cost of capital, and then arrive at the terminal value. The combination of horizon value and the terminal value will give you the enterprise value of the company using this discounted cash flow technique. Now, most mature companies would they necessarily have a DCF. I think obviously the assumptions that go into one model versus another model could be very different. There are a lot of investment analysts out there who would have different views of the same company, and therefore different target prices for the similar company. Again, depends on the assumptions that are being used to forecast both the horizon cash flows and also the terminal cash flows. I think one of the most important aspects of getting your story out to the investors is the pitch deck. Now, the pitch deck is nothing but the narration of your storyline to the investors. Investors typically have very, very limited time to assess a company. One of the things of how do you reach to these investors, right? So you could use various cold forms of introduction, either through a LinkedIn. But one thing you have to understand and realize is that these set of investors get probably hundreds of thousands of emails on a monthly and a yearly basis, and therefore it's very difficult for them to identify which teams to be, to talk to. So I think one of the things that is recommended is that use your networks, very well to be able to get, a warm introduction to, the specific investor that you're looking to meet. It could be, a, a friend who has already been invested by this particular investor. It could be an acquaintance where you will request them to give you a lead to the investor. So, if it comes to a warm introduction, I think the VCs will typically feel comfortable that they know, they would know of you from someone else, and therefore being willing to give you that, maybe that 1 hour, which is important for you to be able to narrate your story. So again, very, very important is, the hustle and the persistence that you need. There's a lot of patience required. Many, young companies go through a lot of rejections, and that can demoralize you, significantly. But this is a long game. You have to be patient. You have to do a lot of networking. You have to really good, be good at telling your story, right? And typically, when you're narrating your story, I think there are four key aspects which the investors are looking for, and which are being captured here. The first important aspect is the size of the market. So as we had discussed earlier during the presentation, that investors are looking for outsized returns and therefore outsized execution. The definition of the way you're defining your market and the size of opportunity, right? So one of the terms that they use is called the total addressable market as you define for your product. So what is the definition of the market in which you are wanting to participate, and therefore how large can your idea become if you become successful? So they are looking for such outsized ideas which at scale can grow significantly, because they are now addressing a large market opportunity. For you to be able to also demonstrate the network effects, in specifically in the social media, media companies, we have seen that users get users, and as more users come in, they would get their friends, and it would be therefore become viral, right? So the network effects that start playing out in these businesses at scale, gives helps them to not only accentuate their revenue, their growth, user growth, but also their revenue growth, and decrease their overall cost of acquiring customers and retaining them. So investors are looking for that. How does at scale your business start, making a lot more, revenue with lesser cost, which in effect is called the network effect that you will be able to provide be able to get in your business. Outside the market, I think the single most important thing is really the people and the team, specifically the founder themselves. That why should they be investing in you versus so many other ideas and founders available in the market? What they are looking for you, not only the idea and your narration of it, but also how would you go about executing it? Because execute, as I had said earlier, that execution will trump any new idea, because the idea itself will not help you establish the product in the market or be able to monetize it. As one of the things that the investors will look for is your ability to attract quality talent and people, because as the company starts scaling, it's all about then how are you able to get more of the similar DNA in your company and build a company culture that helps the company to grow and outgrow the market. Coming to the most important aspect, which is the product or the service that you are going to take to market, that how have you gone about conceptualizing this and converting it just from an idea to the prototype. The prototype is nothing but it would be a half-baked product idea which is being executed for you to test the market, because sometimes it makes sense to go with a half-baked execution effort to test it out with your customers in a small test group, because you will get a lot of quality feedback in what is that you are able to achieve with the execution effort. You in your mind you may be thinking that you have a great idea, but if it does not get customer acceptance, then you would have to rework and go back to be rebuilding that prototype. So the idea here is to experiment a lot, to fail fast, take those learnings and then convert it back into the execution mode. The investors are also looking at entrepreneurs who are able to really stay close with their customers, are able to experiment a lot, and are also able to take that feedback and convert it into visible action. One other concept which people talk about in the great ideas versus the good ideas is, is it a vitamin or an aspirin, right? So as we know, vitamins are for general goodness, but an aspirin solves a specific problem. And investors are looking at businesses or ideas or companies that are providing that specific solution to a user's problem, and not be a general solution itself. So for that, you need to be either connects better, faster, cheaper. So you will have to demonstrate that is your idea new in the market, or is it an existing idea which you are being able to execute and effectively and efficiently. It could be in terms of speed, it could be in terms of cost of delivery, it could be in terms of effectiveness. So these again have to be talked about when you are pitching to the investors. Sometimes we get wedded to our ideas and our execution, because we think this is and we start holding them very dearly. But then what you need to do here is that you can have strong belief, but hold them weakly, to be able to take the feedback back from the market and be able to customize the offering in the market. The last aspect is around the GTM, or the go-to-market strategy. That do you have that in place? Sometimes just technology founders or technology ideators, they may have great idea, are able to make a great product, but they would not know how to take it to the market. So you would then need either the right kind of teams in place to be able to also conceptualize the go-to-market strategy. That what would be the test users that you will go to, how will you then start scaling it, in what are the channels of communication that you will use, what is the advertising mediums that you are going to use to be able to go and acquire customers. And not only acquire customers, but also retain them, right? So again, the cohort analysis of how many users you are able to attract at the top of the funnel, and then also be able to retain them over time, are important metrics that investors are looking for, and which you need to track very, very closely. The last aspect is around handling critique. I think as we discussed, we have to really listen to the market, not be wedded to just our ideas, but are able to pivot the business, the product or the model to suit the customer, because ultimately the customer is going to pay. You have to monetize from that customer, and if you're not solving for their specific need, they may not come back to you. So with this, I come to an end of this presentation. I wanted to dedicate a few minutes. If anyone who's attending have a few questions, I'm happy to take them on now.
Hi, Uncle. It was really good to have you here with us today, and I thank you on behalf of the whole team of Profitech that you took out time and actually shared valuable info with us today. And I really found the analogy of vitamins and aspirins in the case of investors really interesting. So I noticed that we have a few questions from our audience in the comment section.
Sure.
I'll just feature them right now.
Sure.
Yeah. So this is our first question.
Yeah, sure. So Nimish, asked the question, difference between an angel investor and market investor. Nimish, an angel investor is, our early stage investors. They are also called seed investors, which are really investing in the seed stage of an idea of a company, or the idea, generation stage of a company. And whereas the market investors, if you mean the public market investors, are investors who are investing in public companies. So the overall profile of these two set of investors are very different. The angel investors or seed investors are high risk investors, and because they are high risk, as we had discussed, that more than 90% of startups don't see month 12 of their journey, which means necessarily that all these angel investors will stand to lose a lot of money if their investee companies do not go and grow in the market. Their ability, therefore, to take that risk is because they expect that a few of those bets will be large-sized returns. Whereas a public market investor are mature investors, they look at investing in companies which have already been around for a few years. They have matured in their business model. There's a clear way to forecast their operating cash flows and be able to do a discounted cash flow method of their overall analysis for their investment value. So the profile of these two investors are very different. One is willing to take that risk because they are expecting the higher return, whereas the other investor is looking for making an informed investment by using the advanced tools available, the transparency available, because these companies have a lot more data, a lot more history behind them, and therefore our ability to forecast is also significantly higher. But then the returns expectation will also be that much lower.
Okay. So our next question is right here.
Yeah, hi Ria. So there's a question on, is there any way to accurately know whether a certain type of business will benefit more than a debt or equity method of funding? Yes, Ria. So businesses which get to a maturity stage faster are best financed through debt because the overall risk for that business and that idea becomes significantly lower. So as we had discussed that, once you start giving up equity, you're not only taking investment, but you're giving the upside, or the future upside that you're able to create with your idea. So if this business is going to be significantly risky, which means you need a lot more capital to get to a profitability stage, then you're better off taking an equity investor who can co-share that risk with you, but then also co-share the returns. However, if you're confident of the stage of your idea and that you will be able to turn profitably faster, then it makes sense to be bootstrapped and or take very little debt capital versus giving up equity. So that would be the way in which you would think about taking debt or equity in your business.
Okay. Now moving on to our next question. It's right here.
Sure. Aditya asks, how much is the discount when converting to equity? So this is a negotiation, Aditya. There are no good or bad answers here. It is like pricing. It's a demand supply thing. Companies that are attracting a lot of investments, they can get a lower discount to the future equity rounds versus companies that get less interest from investors where they are able to bargain for a higher discount. Right. So it's typically we expect the discount itself to be anywhere between 10 and 40%. Obviously, the 10% would be where companies all have access to a lot more investors, and the overall demand for their company stock or debt is higher than others.
Okay. So our next question is by Riya Gupta again.
How do businesses calculate the runway money accurately? As in, how do they factor in unexpected costs? So yeah, that's a good question because there are obviously few things that you can you can forecast very accurately, right? So your current, for example, your employee costs, your current size of team plus the expected recruitment that you're going to do, you know that you would need a certain amount of capital. You would also then look at the operating burn, which means that if you are selling your product, but you are not able to recover the cost of making it, or overall you're not able to recover that, then there's a certain gross margin or unit economics that you need to fund. So that's the other part of the calculating the overall operating burn for the company. And the third is obviously keeping certain monies for unexpected events, right? And things like COVID, for example, that happened. Now we can never forecast with accuracy of what unexpected things can be encountered in your business. So what typically you would do is then you would if you are a little more conservative, you will extend the amount of investment that you will be raising initially. So instead of having 12-month runway in your bank, you may want to keep 18 months or 24 months. So that additional 6 months or 12 months of capital that you have now taken are to meet these unexpected costs. So you can't typically factor them, or you can't forecast them, but then you will adjust your overall runway in terms of money in the bank versus the cost of operating the business by extending the overall runway by taking more capital or reducing cost or burn according to the needs. So sometimes unexpected events, like in during the early stage of the pandemic, we saw a lot of businesses, cutting down their costs significantly because it was not very certain that investor money will start coming back into the market. So in the first 6 or 9 months of say of 2020, almost all the companies, including the startups and cash guzzling startups, reduce their operating costs and increase their runway without raising additional capital.
Okay. Now we have Akshita Saxena in our comment section, and this is a question.
Sure. Akshita asks, how can a company determine exactly how much they must raise as equity capital? So Akshita, I think it's about really the need. As we discussed, what are the horizon needs of the business, right? And you can typically say, okay, there's a 6 month, 12 month, 18 month, 24 month, forecast that you need to make for your business and this stage at execution. And what you would therefore do is raise sufficient capital to be able to meet those goals. Now, businesses that need multiple rounds of financing, you will also look at what metrics do you need to reach to be able to attract the next, round of investment. So, for example, there are, VC investors may have told you that come back to me only when you are at a $10 million run rate revenue, right? And you are currently say $1 million run rate revenue. So for you to get to $10 million run rate revenue, you need to acquire so many customers. You need to, sell so many goods or units of services, and therefore be able to forecast that okay, I need so much capital to be able to attract the next round of investment, but that I can only do once my business goals and metrics hit that number. The other one is the usual suspect around what are the operating costs and the burn of that business, to determine exactly how much equity you would raise in this round. So raise enough to be able to sustain yourself for the near future in that horizon till you get to the business goals and metrics where you feel comfortable that there will be another round of investment that you will be able to attract, or become profitable. Right? You don't necessarily have to raise multiple rounds, because if your business can generate positive cash flows, then raise only as much as required to be able to get to that stage.
Now I think it's time for our last question. So it's right here.
Yeah. So Shobits asks, what's your advice for fresh entrepreneurs during this pandemic? I think this pandemic, while there have been a lot of challenges, there have been significant opportunities, right? So just say in India, in the first 6 or 7 months of this of this year, we have seen 17 new unicorns being born. So I remember, 3 years ago, we were discussing, that by 2025, India will have 100 unicorns. Unicorns are, companies that are $1 billion plus valuation, but we've already surpassed, 50. So I think there's going to be a lot more innovation, a lot more, digital first businesses that are going to, get, who are going to be born in the next few years. So so you don't necessarily have to create the next, social media platform in the country. I think even looking at existing problems of consumers and businesses and how do you solve them differently by using digital means will mean that there will be a lot more innovation, a lot more entrepreneurs who would want to make that difference. Sometimes you may be able to hit an idea which can really become very large, but then there would be enough and more examples where you could also start a B2B business which is serving businesses, which we don't hear about it a lot, but they are very, very profitable. Especially the SaaS kind of businesses where you're able to you know uh, make those solutions and and also get subscribers to it and sell it as a platform service. So I think there is a lot of lot of opportunity specifically today, because so many more users have now starting to become more digitally savvy. They have moved their offline transactions to the online world. There's a lot more trust today in using the digital means of both consuming products and services. So the opportunity is pretty immense.
Okay. Uh, Thanks a lot for clearing our doubts. And once again, we at Profitech are really grateful to you for being here today and sharing valuable information. And it was really, really informative. Personally, even though I'm from the CS field, I still gained a lot of information through the session. So I hope this helps our hackathon participants as well. So we really look forward to interacting with you in the future.
Hey, thank you,
Thanks a lot,
Vidit,
Mr.
and
Rahul. Yeah.
wish you and your team all the best for the next couple of days as you go through this event, and also
Yeah.
successful completion of your education. So, looking forward, for some of you to start becoming entrepreneurs and run startups very soon. So, wishing you all the best.
Thank you. And as you can see, I think a lot of people have benefited from this uh, session, and they have complimented you a lot. So I think that's proof enough that this session was extraordinary and brilliant. So thank you once
Thank
again,
you, Vidit.
and I look forward to interacting with you in the future.
Sure.
So
Cheers. Thank you.